U.S. 10-year yields, they are climbing towards their highest level since the financial crisis as continued resilience in the U.S. economy pushes investors towards the possibility for further interest rate hikes. July's Fed minutes are also adding to the momentum. Investors are now seeing a 40% chance of a rate hike by November. After the release showed participants are wary of the possibility that inflation will not ease and further hikes will be necessary. A quote from the minutes says most participants continue to see significant upside risks to inflation, which could further require tightening of monetary policy here. Now, one, of course, tool that we always kind of look at to see where things have been moving around, CME FedWatch tool, just to see where some of those probabilities are. As of right now, where we're sitting is still for the next meeting in this September meeting for no hike and for them to just really look across the data that continues to come in. But then once you get out to that November meeting, that's where we start to see things get a little bit more of a toss-up scenario with only 60% of it leaning towards a no hike versus the 40% or 36% as you're seeing here on the screen. This moves around a lot for a 25 basis point rate hike as well.
Yeah, whether you get another, there are a lot of different schools of thought on all of this. Yeah. One school of thought says, well, if they raise again or they don't raise again, it's somewhat marginal because a lot of the tightening that has already been done is still making its way through the system. There's another school of thought that says that they've already tightened too much already, and any more will perhaps cause further damage to the U.S. economy. Whatever school that you are in, indeed the minutes yesterday seemed to tilt more in that direction. But I found a note from Krishna Guha, Evercore ISI vice chair, interesting on this point, who called this an emerging tension between inflation data that is moderating faster than the Fed anticipated and growth data that is coming in stronger than the Fed anticipated. So this is really the conundrum that the Fed now has on its hands, because can inflation data continue to moderate while we are seeing the growth numbers that we are seeing? For now, yes, although many economists we've spoken to have said we could see a reacceleration of inflation before year end. What's interesting is Krishna still thinks we are not going to get the Fed raising rates once again because he says downside surprises on inflation mean the real rate path is already higher than anticipated. In other words, it sounds like he still thinks the Fed is going to weight more heavily the inflation data compared with the growth data going forward.
And on that data front, I mean, data continues as they had talked about in their meeting and as was shown through the minutes. Data is continuing to point towards a robust economy, but retraced part of that move after the June consumer price index release was interpreted by market participants as softer than anticipated. And so it's some of that softness and areas of weakness or softness that the Fed is continuing to monitor to really figure out, okay, have we done enough tightening at this point, and where do we avoid the risk that you're bringing up of over-tightening towards what has been taken off the table from many of our conversations, an all-out recession. It seems like we've moved into the swift or easy soft landing without a potential recession.
Right. Something else Torsten Slok of Apollo pointed out is that you have an unusual amount of agreement among the Fed officials, which is kind of interesting here. He's been tracking the dissents and says the dissents are going down and agreement is going higher. One final thing, as we look at bond yields, where they are this morning, that has been a real headwind for large cap tech in particular as of late, with yields where they are. The 10-year yield now at 4.29%. It's touched 4.3 also, so that's something to keep an eye on. It seems to have had diminishing returns or diminishing obstacle to large cap tech as of late. It doesn't seem to be as much of a problem, but we'll see going forward because that's something investors have been watching closely.